Afternoon all. My name is Deborah Brent. I'm the Senior Director of Business Development and Marketing for the Asian American Chamber of Commerce. On behalf of AACC and our webinar sponsor, Avalara, the leader in tax compliance solutions, it is my pleasure to welcome all chamber members, guests, and attendees to our topic, Financial Insights on the Economic Nexus. So before we start with our program, I invite everyone to stay connected to AACC for membership, event sponsorship opportunities, and save the date for our signature event, the Jewels of Asia Awards Gala on May 25th, 2021. Nominations are still being accepted for our awards categories through March 31st. So please visit us at www.asian-americanchamber.org. Certainly now, I do want to turn over our floor because we have a full agenda and wonderful information from our keynote speaker, Scott Peterson from Avalara. But, before I give him the floor, I just really want to thank everyone for making a little time in your schedule, today for this very important topic, and also for your support of the chamber and also joining us today. So, Scott, the floor is yours.
Thank you very much, and I'm going to share my screen. There it is right there. There we go. Now I gotta swap these out again. Pardon me. I can never remember which one of these. Right there. Very good. Thank you. So thank you very much. It's very nice to meet you all, and we truly appreciate you giving us this opportunity to chat with you about something that is oddly, and I say oddly because I never imagined, honestly, I've been doing this for 30 years and I never imagined I'd actually be where I am today, which is having a conversation about everybody being a taxpayer. All of us think of ourselves as a taxpayer, and we are all taxpayers. But if you're running a business in the United States, or frankly, a business anywhere that's doing business in the United States, you're a taxpayer everywhere because of this concept of economic nexus. That's me. I've got mostly a government background, but I'm becoming quite well versed in technology, which I never thought I would ever have to do. But bad enough that I have to learn Excel. Now I have to be an expert in Excel. So we're going to talk a little bit about Wayfair, what economic nexus means, what it means for a CFO, because it means something very specific. And it's a phrase that everybody's familiar with, and it's risk. This is what the South Dakota versus Wayfair decision did in 2018 is increase risk. And then I'm going to talk a little bit about an event we have coming up in 2 months. We call it Crush. Crush is our user conference. I would like to call it a tax conference. In an in-person year, it is a tax conference. In a virtual year, it's more of a user conference, more of a big picture, what's going on in the world kind of conference. Prior to June 2018, we lived in a world where what you needed to know about state sales tax, you got to control. And you controlled that because you decided where you were going to be physically present. And in those days, physical presence was the trigger. If you had an employee in a state, maybe, maybe not. If you had 50 employees in the states, yes. If you had a store in the state, you had inventory in the state, you were doing something legitimately physical inside that state, you had to have knowledge about what that state's tax structure was like. Well, the states have always disliked that. They've always wanted something closer to sales. They tried for, so the physical presence rule was established by the United States Supreme Court in 1967. And from 1967 to 2018, the states sued businesses trying to get another case before the Supreme Court, did that twice. They lobbied Congress to get Congress to exercise their authority under the Commerce Clause to make businesses do this. I spent 10 years lobbying Congress to get that done, never got that done. So there's always been this desire on the part of states to have everybody that's making sales inside their state collect their sales tax. And honestly, I never thought they'd get it done. You know, like I said, I lobbied Congress for 10 years, never thought I would ever get to a spot. I always assumed that if there was going to be a solution, it was going to be driven by Congress. That Congress would figure out what was the right balancing act between giving states authority and forcing states to be simpler and more uniform than they were. And that at some point in time, we'd hit that magic number and they'd pass something. Well, they didn't. And then I think the Supreme Court actually got tired of waiting. And then they got tired of the having that physical presence rule overshadow other decisions that they had made and decisions they'd like to make when it comes to the Commerce Clause. So they actually took the case again, and which surprised everybody. And then to be even more surprised, actually agreed to South Dakota. So what South Dakota's law said, which is what the Supreme Court opined on, was that if you make more than $100,000 in sales into their state, or more than 200 separate transactions, then you have to collect sales tax. Simple economic nexus test. Your sales exceed a certain amount, you have to start doing something. And the threshold, the $100,000, was designed to be a small seller exception. It was in effect a due process clause analysis. What is the minimum connections that you have to have with the state before the state has a right to make you collect their sales tax? Now, no one actually knows what the Supreme Court would say that minimum connection is. So what South Dakota did when they wrote their law was, we're going to give it to you. And we're going to make it one that excludes a lot of people. We don't, at least in their first bite at this apple, they didn't want to overplay their hand. So $100,000 in sales into South Dakota is a pretty good sized business. In their brief of the Supreme Court, they said anybody who makes $100,000 in sales in South Dakota is likely a $30 million a year company. Well, you know, I wouldn't begin to try to defend what is or isn't a small company, but $30 million is a fairly good sized company. So that was the law the Supreme Court had in front of them. And they paid almost no attention to that law. What they really said was the decision we made in 1967, which established this physical presence test, was a bad decision. And they said it was wrongly decided in 1967 and they threw it out. So they overturned, what is that? 50 years worth of precedent, which immediately scared the heck out of everybody who thought, whoa, if this was wrong in 1967, does that mean I've been wrong since 1967? Fortunately, the South Dakota law saved everybody, because the South Dakota law included a provision that said it would become effective only if and only a court decided that it was constitutional. So the Supreme Court, South Dakota did their homework. They looked at what makes court cases lose, and they tried to create a set of facts that made the Supreme Court comfortable. And now everybody has this opportunity if they want to take it. And we're up to almost every state having this. Now you all know economic nexus, and you all know the way that we've changed how we do business. If you want to make sales in a pandemic, you have to be online. You have to be able to ship your products or your service to people who can't come into your store. And we've all done that. Avalara's done that. I mean, within 10 days, we had 3,000 employees that went from offices to their homes. And everybody else that had the luxury of being able to do that did exactly the same thing. And now we're trying to figure out how we get all those people to come back into office. But the impact of the Wayfair decision, the states got painfully lucky, because this decision was decided before the pandemic. And so there were almost every state that has the law today had it a year ago when the pandemic started. And so all these states that were able to say to sellers, we're sorry, we're closing your business because we're not going to let people come in there and infect anybody else. But we're still going to make you collect our sales tax if you're managed to switch your business model from over-the-counter sales to online sales. So I've told you what the South Dakota law was. It is and this is in every state that has adopted this, which is every state except for Missouri and Florida, have basically the same parameters. They define economic nexus as a certain number of sales. Once you hit that number of sales, then you have an obligation to collect their sales tax. The sales that you make before you get to the threshold only count getting you to the threshold. There's no obligation to go back and collect tax on the sales that you made before you hit the threshold. Now, what is a little bit frustrating, and which is something that I think accentuates the risk that businesses have today, is this economic nexus rule didn't replace anything. It's layers on top of all the things that used to exist, which for most of us is physical presence. So to the extent that you have employees that are living in a state where you're not collecting sales tax and they're doing so because of the pandemic, you know, you need to think about whether or not those employees create physical presence for you in that state, and whether or not that created an obligation for you to collect sales tax the moment they move there. Something that we've had to consider at Avalara. I mean, what we do is taxable in a lot of places. And we've had to think about where our employees moved when we sent them home. We got lucky. Most of them, you know, just moved to their home. They didn't move to a different state. But to the extent that they move to a different state, there is that likelihood that, and if they stay there, you know, you've created physical presence in that state. Well, physical presence is a different test. And well, the outcome of the physical presence test is different than economic nexus. Remember, economic nexus, you get to make sales into a state without collecting sales tax until you get to the threshold. Well, for physical presence, you get to the threshold immediately. The threshold is physical. And so if you have an employee in a state that, you know, some state would argue, you know, helps you develop or maintain a market in that state, they expect you to collect sales tax the day that person moved there. Now, there is no threshold. You just got to start. Just a map that shows you how things evolved. So the map on the left was June 21st, 2018. Obviously, South Dakota had this law. The other states in blue had a law like South Dakota's, hoping South Dakota would win. And they got lucky. Now, the bad news is Kentucky, Hawaii, and Vermont, their laws just coincidentally went into effect on July 1st. So the decision was issued on June 21st. Hawaii, Vermont, and Kentucky's law went into effect on July 1st. Everybody on the planet had 9 days notice that they might have an obligation to collect sales tax. In all three of those states, the threshold year, so I told you, you have to count your sales into a state. It's on an annual basis. So you make, in all these states have the same law. You have to count the sales you make into a state on a calendar year. So if you exceed the threshold in the calendar year, you got to start collecting. Well, in Vermont and Kentucky and Hawaii, the threshold year was 2018. No, 2017, excuse me, 2017. So everybody on the planet got 9 days notice that they needed to look back at their 2017 sales into Vermont, Kentucky, and Hawaii to see whether or not they exceeded $100,000 of sales in those states. Because if they did, those three states expected you to start collecting sales tax on July 1st, 9 days after the Supreme Court issued its opinion. Just bad timing. The map on the right is effectively today. Every state in the country has this law except Missouri and Florida. And we're predicting that by the end of this year, Missouri and Florida will have this law as well. So every state in the country will have it if the state has a sales tax. There's 5 states that don't have sales tax. The acronym for those 5 states is NOMAD. It's New Hampshire, Oregon, Montana, Alaska, and Delaware. The catch in the NOMAD states is that While Alaska doesn't have a state sales tax, there's 110 cities and boroughs, borough is their word for county, boroughs in Alaska that do have a sales tax. And what they've all done is band it together. They created a little Department of Revenue just for sales tax purposes. They've all adopted exactly the same law that South Dakota adopted, that the Supreme Court opined on. And they now have the belief that because they act as one, and they all have the same ordinance, and they've created a way for you to file one return and make one payment, that they should have the right to force Belgium retailers to collect the local sales tax in Alaska. It's a fascinating world. Oh, okay, so one of the problems, I said South Dakota had a law, and every state adopted basically the same law as South Dakota. What they didn't do is adopt exactly the same law as South Dakota. They adopted a law that's slightly different. South Dakota, $100,000 in gross sales plus or 200 separate transactions. Well, North Dakota, which is right above South Dakota, obviously, they adopted $100,000 in taxable transactions, or taxable sales with no transaction component. So if you, two states, virtually identical. One, it's $100,000 in gross sales or 200 separate transactions. The other is $100,000 in taxable sales. Well, the difference is sales for resale, basically. So if you're someone who has wholesale sales into those two states, plus taxable sales into those two states, and that's a fairly common business, that you are going to get to the threshold much quicker in South Dakota than you would in North Dakota. Matter of fact, you may never hit the threshold in North Dakota, selling exactly the same thing to exactly the same type of customers, simply based upon the difference between taxable sales and gross sales. And that scenario plays out all over the United States. It's gross sales here, it's taxable sales here. In Arkansas, it's retail sales. I'm not sure what a retail sale, I know what a taxable sale is. I don't know what a retail sale is. I think every sale is a retail sale, maybe not. And then there's different thresholds. California and Texas is $500,000. Alabama is $250,000. So in Kansas, it's zero. They're doing something extremely odd. If you're going to go home and or go back to your office and do some analysis on where you may have risk, start with Kansas, because Kansas does not have a threshold today. Any sale that you make into Kansas is taxable according to them. I think that's going to change. We expect them to adopt legislation this year that actually puts in place a threshold. But the last law, I just read their latest legislation yesterday, and it's $50,000. So it's what could have been a very simple concept. Dollars, maybe transactions, is now painfully complicated because, while it's still dollars, it's not the same number of dollars and not the same type of dollars. Some states there's transaction level as well. Some states there's not. I told you Florida and Missouri are going to do something this year. So there's what this means for people is that your customers now decide what you have to know. You no longer have the luxury of getting to plan what your tax department has to understand, because it's that marginal customer, that customer that takes you over an economic nexus threshold in the state, that determines that you have to know something about that state. So to plan for that, now you have to do a different kind of planning. Now you have to plan for where you're going to exceed a threshold, which means you have to keep track of your sales by state. And you have to keep track of the thresholds by state, whether it's gross sales or taxable sales. You also have to get, actually, in most places, you have to actually keep track of the number of transactions you're making in a state. So if you sell a lot of low dollar things, you're probably going to hit the 200 separate transaction thing long before you hit $100,000 or whatever the threshold is. So you have to have that all in a way that you can, and it needs to be dynamic. You know, every time you make a sale to someone in a state, your tracking system has to be able to know that you made a sale into South Dakota, or you made a sale into Vermont, you made a sale into New Mexico, so that you can plan on when you're going to exceed that threshold, so that you can plan on having a tax license and the physical capacity to collect whatever that state's tax is. And they're all over the board. In Arizona, it's called the transactions privilege tax. In New Mexico, it's the gross excise tax. It's the gross receipts tax in Hawaii. Don't call Hawaii and want to ask them about their sales tax, because there'll be a long, unpleasant pause, and they'll say, oh, sure, here's somebody from the mainland, doesn't understand what we do. And they'll say, do you mean our gross receipts tax? And you're going to say, I don't know. I want to talk about your sales tax. And so you're going to have a 1-minute awkward conversation. It's different there. It's called something different there. Not only that, they have a tax on wholesale transactions. So they have a state plus island tax on sales. But if you're making wholesale transactions, they have another tax on that as well. And they think Wayfair gives them the ability to force retailers in New Hampshire to collect that tax as well. Getting the business license sometimes is easy, sometimes it's very hard. Some states want you to start collecting the next day after you hit the threshold. Some states give you 30 days. A couple states actually give you 60 days. All those things have to be factored into that moment when you start. Actually, the moment before you start. All these things have to be in place. And the thing, and it's not just that they call them different things. They have different rates. They tax different things. They tax the same things at different rates from each other. They have different definitions for the same things. There's 13,000 local governments in the United States that have a sales tax. Most of them follow whatever the state's rules are, but in Colorado and in Arizona and Louisiana, Mississippi, or Louisiana and Alabama, they don't. They don't have to follow what the state's rules are. And the majority of them are cities. And the one thing that's every city has in common is their boundaries change. And whenever a city annexes something, the boundaries of their tax jurisdiction changes. So, and sometimes they do this very orderly. Sometimes it's every day. And so you have to know when the city's boundary changed, the effective date of that change, so that you know whether or not the customers that you had that used to be outside the city are now inside the city and your tax rate changed. Okay, so I'm going to jump down here and get to, I want to talk about, before I go back and talk about, I want to talk about this because we're down to 5 minutes. So we do this thing called Crush, and Crush is our user conference. And it's usually 3 days. We invite, all of our customers to come. We invite anybody that wants to be a customer. We invite the media. We invite politicians. We invite in, accountants and lawyers, law firms, accounting firms, anybody that wants to come in and listen to us talk about ourselves, which is really what this is about. We come in, people come in and listen to us talk about ourselves. But in the real world, in the non-virtual world, real world, I guess it's real both ways. In the non-virtual world, we do this with over enough days that we actually get to talk about taxes. In the virtual world, we don't have the time. We can't make people set for 3 days. So we're doing it. It's mostly about the things, frankly, that CFOs need to know about this. And I hadn't thought about that till this very presentation, that our virtual Crush is actually more the kind of thing that a CFO or a controller or a VP of tax should do, because we're going to talk about the future. Where is tax compliance going, and worldwide? Because we do business in about I think 125 countries. We do value-added taxes, goods and services taxes, whatever that company has or that country has. And so we're hoping that this conference gives thought leaders an opportunity to imagine where their business is going to be in 5 years, and to think about, okay, so taxes, boring, but it's a pain in the backside if you get it wrong, or if you don't get it done at all. And so if my business is growing this way in this place, how do I be prepared for that eventuality? What do I need to put in place? What does my accounting system need to do? How does it need to connect? Do my stores and my website have the same accounting system? How am I keeping track of the sales I make on marketplaces? Am I able to do tax compliance in all three of those different places in the same format at the same time? So we're all multi-channel. We want to make sure we don't get this wrong. Everything's becoming digital. I mean, a big part of my job is to convince cities and counties to create an electronic version of whatever it is that they require of businesses, because no one wants to write checks anymore. No one can go in and drop off. You would be shocked at the number of cities in this country that have a tax on lodging where they expect you to show up on a day and drop off your return with a check. Well, we didn't do that in the pandemic. We didn't go to anybody's office. Thankfully, they were mostly closed. So we were not having to do that, but it exposed everybody to this big gap that we have in our and their ability to do business when you can't look at each other. So we're like I said, that's part of my job. Every day I'm trying to figure out how to get that done. These are some of the folks that are that we've already got as speakers or as attendees. We're going to, like I said, this is going to be a thought policy, a thought leadership day. We're going to talk about within the regulatory game change. How do you keep up with the different things that governments are doing around the world? How do you do it when you're a multi-channel person? What is the obligation? What's the challenge? Not the obligation. Obligation comes regardless of what your challenges are. What are your challenges to be multi-channel and get the tax obligation right? The digital mandate. I don't honestly know where we're going to be in 5 years digitally. This week, I have been reading about central bank digital currency. We need to move money cheaper. We move $1 billion a month. We have to do it in a way that costs us less money. And the digital currency seems to be a way that I think most of us can get, maybe some excitement about. And if I can do this in a way that doesn't cost us anything, or, does my bank transfer fees for a fraction of what I spend today. Then we have this thing called Crush City, which is, this is really more of our tax part of it. The opportunity for you to come in or you to have your tax department come in and, and talk with each other about the challenges that you're having. So I am at the end of, I take it back. Here is it's complimentary for right now. We're going to stop being complimentary pretty soon. And we would certainly encourage you guys to take advantage of the current pricing. And I am out of time, but I have to drop off because I now need to give a presentation to another group. So Deborah, thank you so much for this opportunity.